All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Let's go out and take a look at the market action. Kind of what do we take from the Fed reaction, and the overall kind of price action that has happened after it, and what do we ultimately assess and analyze from that. And I'll show you kind of how I look at things, how I'm looking at things in light of, what's going on with the Fed. Here's S&P futures, and I'm just going to zoom in on this week. Right? I'm just going to zoom in on this week. One thing we can see is that the highs have gotten lower. Right? The highs have gotten lower. Now, that's assuming that right now is a high, which I think is a terrible assumption. There's nothing to suggest that the high is right here, right now. It could ultimately be, but, is it saying anything overly bullish, overly bearish? Well, we basically have S&P futures range, and right now S&P futures are sitting pretty much smack dab in the middle. They're about 20 points off their lows. They're about 25 points off their lows, and they're about 18 points off their highs. So, if they were to fall 3 points, they'd be smack dab in the middle. So overall, just pretty kind of, lower highs, lower lows, market sitting in the middle, but really not a lot to take from that action. It's not breaking out of any ranges. It's not, excessively trending, when it comes to the price action this week. What about the IWM? Well, here's the IWM this week, right? It's high up here, low down here, and it's smack dab in the middle. Okay. What about the Qs? Well, this is where we start to see something different. Lower highs or higher lows, higher highs. This is different from what we see in the S&P and what we see in small caps. And the Qs are sitting at highs. In fact, they just hit a new high on the week, a new multi-week high, a new multi-month high here this morning. This is a very bullish chart in terms of the Qs. What about international markets? International equities, something like the FXI. Well, it's sitting at its lows for the week. Just slightly off its lows for the week. What about the emerging market index? Well, it's pretty much smack in the middle of its range for the week. What's my point? Tech strength, rest of the market, muted. Rest of the market looks muted because of financials, where financials are sharply off their highs from this week. They're sharply off this. So that's weighing. That's not weighing into the Qs, right? That is weighing on the other indexes. So we're sitting here looking at a market that's heavy tech strength and that is heavy in terms of its chop through a range. And what we've had since the Fed is simply that. What's been the ultimate reaction high and reaction low from the Fed? Right? Here's the reaction high, here's the reaction low, the pre-Fed, right? So we come down, we get into this reaction range. Here we are with the reaction low. And all of the price action has taken place within this reaction high, reaction low area. It's not broken out of this one way or the other when it comes to the overall S&P. That generally denotes that not a whole lot's going on, that there's not a whole lot of conviction one way or the other. There is conviction when it comes to the banks. There is conviction when it comes to tech. So there's that kind of mixed bag. But when we put it all together, we're not seeing a whole lot of conviction, right? There was good volume this morning. Very bullish volume here this morning. If we let me zoom it in here and show it to you. You take a look at the volumes this morning. Compare them to yesterday morning, right? Here's the volume today. Here's the volume yesterday morning. A lot more solid type of volume, coming in here this morning than what there was, yesterday morning. So, we don't have a market, I guess, what do we make from this? We don't have a market that's breaking down big, bad bearish, right? This isn't okay, Fed happened, we get a reaction up, now we pull back, and now everything's all, big, bad, and bearish. There are still some very heavily bullish dominated or controlled areas, and that is mostly in tech. When we get into the banks, that's where the bears can make a little bit better argument. Get into the China, emerging market ETFs, the bears can make a little better argument, in those spaces. But throughout all of this, do we really see any kind of major change in conditions? We don't. You go and you take a look at the bullish percent index. Nothing. Just absolutely nothing here. Nothing going on, nothing changing. We look at the number of stocks above and below 7 and 20-day moving averages. There's just not a lot that's changing. We look at even the volume flows that are out there in the market. It's still what it was. That there's just not a lot, not a lot that is changing, here with that. And I'll pull up the chart here with the cumulative volumes. Right. And you can see we had last week where the volume flows went from this kind of bearish territory into this bullish territory. Overall this week, volume flows are pulling back into the neutral territory just slightly, but they're still kind of what they were last week, in terms of things. But that's kind of what we're looking at. We're not looking at a lot of big change that is going on. And I understand a trader's mentality is, hey, okay, what's changing? What's going on? Where can I take advantage of the change? But the reality is so far that there is none. This isn't something where we can look and go, oh, well, the index is red. Oh, the index is green. Oh, well, it must be bullish. It must be bearish, right? In fact, yesterday, yesterday I was talking with one of you and made the comment, well, it looks like the bears are in control right now. And I just made the comment back, the indexes are red, but there's no change going on. There's no real change in the internals to suggest the bears are grabbing any kind of control back. So what am I saying? The market is what it's been, right? The market is what it's been. What does that mean for someone like me who is maybe a little too bearish to see straight? It means I don't have a lot of entry opportunities, right? I just look, I could sit and stare at CAT and go, well, CAT broke the 7-day moving average yesterday. It gapped down today. And yes, was I watching it looking for an entry this morning? You betcha. Did it give me one? Not at all. Not at all. Right? Here you can see it gap down to the lower Bollinger Band, snap back above the 7-hour moving average. Just doesn't give me an entry point on the downside. In fact, it's a little more set up for an entry point on the upside right here at this moment. Right? What about something like a U.S. Steel? U.S. Steel, all right, it's breaking down yesterday and only to snap and pop back up by 75 cents. Right, and that is something where, do I trust some of these small bearish breakdowns? And so far the answer is no, because we have not seen any of these small bearish breakdowns get any sort of major follow through. You could argue the banks a little bit differently, right? The banks are a little bit differently, but these are coming off of highs. This is a move that's news driven, that's coming off of highs. This isn't some chart erosion type of situation. And so from a bear standpoint, there's just not a lot to sink teeth into and to get even too excited about. Here's something like a FedEx, for example here. Why does that chart look off? Let's come into the daily. Here we go. But here's FedEx, right? FedEx earnings, revenue miss, kind of an ugly report. We have, another downgrade here this morning. It still is not getting sold off, right? And you can take a look at a Micron. And you look at Micron and you look at the report. The report wasn't that good. This wasn't a game-changing report. But it's getting a reaction to the upside that is, significantly better than the report, while FedEx is getting a reaction to the downside that's significantly less than, the erosion in the report. And so we're not seeing this kind of heavy, bear market sell type dynamic come into play. And so it means what? It means I've got to be very cautious. I got to be very careful. I have to really kind of look at my signal and go, okay, or the risk reward exposure here, and with the overall market conditions, exposure just isn't exactly something that looks all that great. Now, that's from a bearish side. From a bullish side, is there anything out there? Right? When I look at the market, I don't want anything to do with SPY calls or trading the market higher or anything like that. You know what? It may go higher. It may, track all the way to 290, 300. We've talked about, the possibilities of those coming in. Nice little bullish engulfing, at least so far here today. But are there any kind of bullish setups, that can be taken advantage of, as the market kind of tracks higher? Because if this market does go higher, it'd probably be an average of 10 points a day, or 0.5% a day type of thing. Well, yeah, take a look at something like a Valero. Here we are, moved up to the upper band, right? We get a pullback in Valero, and then we get this nice, sharp, high-volume reversal where it basically blows away the highs from, the last 5 days. Slow, steady, track on higher, hits up into the resistance area. Finally seeing some consolidation in this resistance area. But look at the volume flows. The volume flows here have changed. They've shifted. They're strongly bullish. This looks like something that may have a date with the 200-day moving average, right? We see the Bollinger Bands expanding. Right, so this is something that has, given some nice little bullish elements, consolidating up at resistance with all looks of looking to break resistance, a very positive MACD, nice setup, play it off of the 7-day moving average for a risk-reward type of play here with Valero. So, there are some things that are setting up that are starting to come on in. Yesterday, we saw Halliburton end higher, right? Break higher. Today, down just slightly. This is something where I'm still looking at it on the downside. But, if you're looking for upside here on this, it is something that, you can use the lows from this week as that kind of stopping point. I'd rather Valero to the upside than Halliburton, if you're looking in that space. But, just kind of showing some examples here. Here's Visa. Visa, any reason for Visa to get hit yesterday? No, it fell with the banks. Right? But it's not a bank. Visa doesn't care about the yield curve. Visa doesn't care about the financial sector. They're not holding debt. They're basically a tech company making money as people swipe their card. It's had a little bit of pullback, nice little bullish engulfing, setting on up. Yeah. Nice little kind of setup if it's able to hold. So, there are some of these starting to, or coming into play. Most of them aren't brand new trend emergers, but they're things that have been on trend that have pulled back just slightly and are now giving a little bit of a better risk reward element here with them. So, I'll be taking a look at some of those here as the day progresses, and kind of, do I have an opportunity to go and play them? I've kind of had my eye on some, as U.S. Steel. But again, it's just not giving me anything there to the downside. In fact, today's price action is pretty darn bullish, especially with this action on the stochastics. This is some of the best stochastics action, that you can see in terms of, just the way a stock will move and get that kind of, shot back up at least into the retracement areas here. I've been looking at BHP for some sort of downside entry. Had a big, bad, bearish engulfing on Tuesday. And what's it done? It's just basically said, who cares, right? Off we go. Higher we go. and we have seen that. I would still like to get an entry point in gold, but just have not found one that I'm comfortable with. With the GLD or the GDX, as they still look like they're consolidating. And then when it comes to the banks, these have been the big laggards here over the last 3 days. They got sold off very hard yesterday. There's the yield curve issue, and frankly, it's an issue that I think is not going away. I think from a fundamental standpoint, the banks were dealt a huge blow yesterday, and the attractiveness of being in the banks right now is probably lower than it has been in a long time, especially when you look at some of the yield curve projections. Then you look at what UBS said yesterday, about some of the banking conditions in Europe. These banks may have a long way to go down, but they're not a great risk-reward entry point, right here at this, at this moment. But definitely has the the three black crows, or whatever you want to call this candlestick pattern of this kind of piercing line, then this kind of bearish Marubozu, and then this gap down. This is pretty picture perfect three black crows reversal pattern. Generally, after it triggers, it gets a little snapback, but generally it hits new lows, and so I'll be looking for that, when it comes down to the banks. So, overall, that's kind of how I look at this kind of market open, or this Fed reaction here so far. There are some very bullish elements. There are some bearish elements. Overall, though, there is no real bearish break in the market, or something where you can go, oh, well, just go buy bearish anything and you'll be good. No, it's definitely one that, one that the same conditions that existed on Tuesday exist today. Same conditions that existed on Friday exist today. And, we could talk about the action of the Fed, and we could talk about what it means for X, Y, and Z in the longer term. And I think longer term, there are some very negative ramifications. But shorter term, there is really just no real change, taking place here. And, from a tech standpoint, it's still a strong bulls world. And, that is, something that has to be respected there. Could this all change? Yeah, it could all change. It could all change fast. It's the market, right? There are things that could change it. We do have some economic data here tomorrow. And we did have some economic data here this morning, and the data was generally positive. Now, these aren't big pieces of data. These aren't generally market-moving pieces of data, but any little positive in this market has been bought. Any little negative has been sold briefly. And that has been the pattern. And we see that here again today. This Philly Fed Outlook survey, which is kind of a look at the manufacturing sector in the Philadelphia Fed region. And you can see down here in the chart this kind of erosion that's been. You can see the big snapback that is here this month. And it was went from minus 4.1 to 13.7. That's a big snapback, right? That's a big snapback here. But it's one where they say the headline at 13.7 and at the high end of Econoday's consensus range may very well overstate March's strength, at least relative to a couple key details into the report. So, you can look at the details in the report and say, well, this isn't really all that great. And you can make a really good argument, right? You can make a really good argument in that. But the reality is there's a snapback, market relief, and, we continue to see, bad news get sold very little, briefly. Good news get bought up to a much greater degree. And, even stuff that may not be that great of news, is interpreted as, as really good news out there. And that is the condition. We did see leading indicators here in the U.S. come in at 0.2. They revised last month's higher. This is one that just has the stock market priced into it a little too much to use it as an indicator for the stock market. But a general positive here with that piece of data. So again, there's not a lot for the bulls to sink their teeth into, other than this argument of yield curve going to flatten. And so far, we do not see the market getting all twisted up about it. Could it? Yeah, it could. And let's face it, this big drop right here. The whole way down, it was yield curve worries, yield curve worries, yield curve worries. I think the yield curve worries are significantly greater right now. The arguments for flatter yield curve in the future are significantly greater today than they were at any time here in December. But it's one of those things where this is a market. Markets react to things on their time. And, eventually the market will react and it will have a yield curve sell-off. Or a sell-off in the equities, based on the yield curve. But so far, no sign. So far, no sign that is coming in. I'm going to continue to hold the cash that I have, as well as Home Depot. I still have plenty of time on Home Depot here, and it's kind of getting up into that area that we talked about as far as that risk factor and 200-day moving average and everything. As it's kind of pushed on up with the market strength and really with the upgrades yesterday, that really kind of made it outperform the market. But I continue to hold that and, looking for a place to put my cash into play. I may, near later in the day, depending on how things hold up, I may, dip my toe into a little Valero or something of that nature. Even maybe a little bit of CAT for the short-term pop into tomorrow. But most likely I'll wait for, the downside, signal. We do have options expiration tomorrow, but it's not the big option expiration, third Friday of the month. This is a different type of month with five Fridays during the month of March. So, that is something that, we'll see a little bit of pinning action, but nothing like, we would on a regular OPEX type of day. Thanks for hopping on. Have yourselves a great one. And we'll talk to you later. Take care.